Hello, and welcome to Idea to IPO. I'm Jennifer Stowell, and Idea to IPO has been holding tech startup events in Silicon Valley for many, many years. We launched officially on February 1st, 2010. At that time, we had no members and no events on our calendar. At this stage, we have over 150,000 members among all of our meetup groups all across the world. We have organized, promoted, and produced over 2,622 events. By any standard, by any measure, we are the most active, most prolific startup event organization in the history of Silicon Valley, bar none. We organize venture capital panels, legal workshops, and more. These days, we are 100% online. We hold an event nearly every day of the week. Check out our schedule at ideatoipo.com. Our featured speakers today are Mark Wald and Patrick Sergott, two amazing leaders in the finance and accounting space for startups, and Jason Putnam Gordon, one of the top venture capital attorneys in Silicon Valley. And they are all passionate about helping entrepreneurs succeed. Ladies and gentlemen, Mark Wald, Patrick Sergott, and Jason Putnam Gordon. Mark, Patrick, and Jason, take it away.
Terrific. Thank you very much, Jennifer. It's a pleasure to be here today. It's always a pleasure to work with Idea at IPO. I used to do in-person events with them, I think starting around 2013, and now we're all virtual. One day, I'm sure we'll get to do in-person events again. Today, I'm very excited to be here and to work with Mark and Patrick. I'm gonna let the two of them introduce themselves in a moment, but I'm so excited because we're gonna be talking about dilution, and we're gonna talk about how to tame your or another founder's, one of their biggest fears, and to use a tool that we call the pro forma cap table. And I'm very excited because I can't tell you how many times in my practice I meet an entrepreneur who has raised, via safe or convertible note, or is planning to raise, and they've already started negotiating maybe a term sheet, and they haven't run a pro forma cap table. They don't know how much of the company they have or are about to sell. That's a real problem. Today, we're going to unpack all of that. But before we get into that, let me tell you a little bit about how today is going to operate. First, we're running a survey. So if you'll take a moment and fill out the survey, it'll be helpful for Mark, Patrick, and myself to cue our discussion to who's in the room. Additionally, I want to remind you that today's event is recorded. There's real upside to that. You miss some or all of it, so long as you've registered, you'll get a copy of it. You'll get to use in the future. Downside is, not only is this a public venue, but it's also going to get reported for posterity. So please don't provide us with any confidential information at this point because it's not going to be kept or treated confidential. So the way the format will work today is that we'll speak, Mark, Patrick, and I will speak for about an hour. We'll move through the material. If you've got questions, please pose them in the chat function, please pose them in the Q&A function. Patrick will tell you he's monitoring the chat function, but it's easier for us to address the questions if we use the Q&A. So let me tell you a little bit about myself, then we'll go around the horn with Mark and Patrick. So I'm Jason Putnam Gordon. I'm a venture capital and emerging growth companies attorney. I live and work in the San Francisco Bay Area. I work with companies throughout California, the rest of the United States, and the world. My particular area of focus is with health ventures, as well as machine learning and AI and autonomous vehicles. But enough about me. I'm very excited to have Patrick and Mark here today because they are outside CFO and accounting folks, and they are sharp. And we've been talking about this event since the end of 2020. Mark, tell everyone a little bit about yourself.
Thanks, Jason. So I grew up in Silicon Valley, went to school at UCLA. I live in Los Angeles now and work with the startup companies down here and across the United States. We also work with foreign businesses that come to the US to open an office here. And I'm really excited to do this presentation. And this will be most useful for someone who's raising a price round right now, but immensely valuable to any early stage company, as those companies need to understand how dilution works when they're raising safes, convertible notes, paying advisors with stock grants, negotiating with VCs, issuing warrants, things like that. So we'll get into it in just a sec. Patrick?
Thanks, Mark. Thanks, Jason. Patrick Sergott, Director of Strategy and Client CFO for Supporting Strategies. I'll be monitoring the chat and Q&A today. Like Mark had said, we work with companies throughout the country and throughout the world. We work a lot with venture-backed startups in a variety of different industries. So excited to be here today, excited to be working with you, Jason. Excited for today.
Fantastic. So let's not keep folks waiting. Mark's going to be, so I'm going to be managing the Zoom tech. Mark's going to be managing the presentation. If you want to pop that up, you can just kind of jump into things.
There it is.
Thank goodness. All right. Well, I think maybe we'll move to sort of the caveats that I got to give. I wouldn't even be a halfway decent lawyer if I didn't remind everybody that, today's conversation is not legal advice. It's not accounting advice. We'll be discussing how things typically operate in the venture capital ecosystem. We might talk about some rules, some laws, but there are exceptions to those, and there are exceptions to those exceptions. So if we provide any information today, or we even address any of your questions, please understand that that's in the context of it being general information. And we're also going to try and make it generally applicable, right? Because we've got several hundred people signed up today. People will be viewing this asynchronously. Don't take any of this as specific legal or accounting guidance. All right, so let's start kind of with the real common problem that I typically see kind of in my office, and I bet Mark gets this from time to time too, when entrepreneurs walk into the room. They've got an entrepreneur who says, all right, I'm raising $1 million on a $4 million pre-money valuation. I'm only taking 20% dilution, right? At the end of that round, I'm gonna have 80% of the company, right? Wrong. The reason why it's wrong is because you haven't, lots of, especially first-time entrepreneurs and even seasoned entrepreneurs, don't really fully understand the concept of what we call fully diluted, or a fully diluted basis. Now, we could probably spend a whole hour talking about what a fully diluted basis is and some of the tweaks and changes that are in the definition of that. But as a general concept, it's good to know that it's common stock and everything that could be converted or exchanged or otherwise changed into common stock. And why does that matter? Well, we'll move into some of the control rights. We'll move into the economics later, but it matters because at the end of the day, when you're trying to figure out really how much of the company you have, if you're raising $1 million on a $4 million pre-money, you don't have 80%. You may have 60, you may have 50, you may have 43, like we see here in this slide. Now, the slides that we show today are all sort of generalized numbers. They're kind of maybe like a composite sketch of what you might get out there in the marketplace. Again, don't set your metric to what we use today, but do know it wouldn't be uncommon to see a scenario like this. Now, we'll move through what each of those things are a little bit later, but let's get into some of the startup equity basics, if you will. Okay, I think it's always important to talk first about big picture. Okay, so big picture here, if you're going to be a venture-backed company, okay, that's a company that's going to need a lot of capital to grow and scale, and it's going to scale over time. This on the left is your typical financing life cycle. Okay, initially the company starts out, it raises some initial capital from friends, family, and others, if you will. Then maybe moves on to some angel investors, all in that sort of zone, which is labeled as the valley of death. And at that point, there's negative revenue of the company. The company is not making any money whatsoever. After that a team is assembled and the initial sort of prototypes and maybe the first go to market come out there and they start to get a little traction in the marketplace, you start to build up that, you start to get some revenue. And maybe at that point, you're going to be doing a Series A financing, at which point that's where you're going to get a sense for just how those safes and convertible notes can bite you in the booty if you haven't thought ahead and thought about your pro forma cap tables. So as you'll see, these subsequent levels of investment come in the Series A, B, and C. And if you look at the right, you will see in the blue is the amount that the founders own. Initially, it's 100%, but then in each raise, they're going to get diluted. And you'll see that it's true. The founder's relative percentage goes down, but the value of the founder stake goes up. Now, here we have on the right-hand side, we go on the left-hand side of that equity dilution and value chart from a company worth 0 to $1 billion. But a company that goes public could be $1 billion, 10 billion, just sort of depends. Mark, do you have anything to add to that?
We'll get into it with a little deeper walkthrough a couple slides in. So we're good there.
Great. Now, I want you to think back to each of those inflection points when those rounds came in, right? I mean, the whole goal here from a venture perspective is to tie various inputs, at least from a legal perspective, tie various inputs into the company to get it to grow in value. So that's making sure that the cap table is papered. Those are the investors, making sure that the IP, those ideas, they're all getting tied into the company. And the company's got those exclusive rights to that IP. And then making sure that all the employees, all the consultants, all the advisors, anybody who's contributing or maybe even sales, and definitely even sales, all of that is getting papered. And when you put those things together and you start generating that revenue, and that revenue starts hockey sticking, the company is going to increase in value. Next slide. So let me give you a little context so we can talk about fully diluted basis. So before I said fully diluted basis is basically every, common stock that is outstanding and all things that can be converted into common stock. So common stock, let's talk about that. That's sort of your base level of stock in a corporation. And in a corporation, ownership is reflected in shares of stock. It's not reflected in percentages. We use the percentages because it's important to understand who's got relative power and also what the relative effects of the economics are going to be. But at the end of the day, an ownership interest is reflected in shares of stock. So common stock is the base unit, the base level, and that gives you the right to elect directors and the right to dividends. You're not going to get dividends in early stage companies. That's something probably post IPO. And importantly, the right to the proceeds on sale of the company after everyone else gets paid. And Mark will, he'll show you that a little bit later. He's got a great slide for that. But let's talk about the names of common stock, okay? Because folks sometimes think that founder stock and advisor stock and restricted stock and stock options are different than common stock. No, ultimately, well, it might get called founder stock, it might be called advisor stock or restricted stock, but we're all in those instances talking about common stock. And preferred stock, we'll get into the bells and whistles that it has. And one of those bells and whistles is usually the right to convert into common stock. But you need to understand preferred stock is called preferred stock because it has preferences, these additional bells and whistles that give it certain rights and privileges and, whether it's voting or other kinds of control rights. And there are other sorts of equity that can ultimately convert into common stock. So convertible debt, safes, those are simple agreements for future equity, warrants, options. All that gets converted into common stock or could be converted. And so when we're measuring a fully diluted basis, we're taking a look at all that stuff at a moment in time and saying, well, what if it all changed into common stock? And then that is our denominator. Mark, anything to add on that?
No, we'll cover those again in more detail a little bit.
All right. So who's in charge of the cap table? Well, I mean, ultimately it sort of resides in the company and the founders, especially initially, but it's usually created by the company counsel, someone like me at formation, where we say, okay, this founder has this number of shares, this founder has this number of shares, you've got this advisor with this number of shares. And then what happens, Mark? What happens? Who manages it?
Well, like you said, Jason, thanks. A good attorney will create the first cap table for a company, usually in a spreadsheet. There's lots of free cap table templates out there for founders to download as Excel and Google Sheets. But things can get tricky fast with a spreadsheet, and it's easy to make mistakes. So there's a ton of cloud-based cap table management tools available with very user-friendly features that leave spreadsheets in the dust. One really useful feature is scenario modeling, which I like to call the crystal ball, because it lets you see into the future and understand the outcome of different fundraising exit scenarios. But just like anything else, you have to know what you're doing to use these tools properly and get accurate results. That's part of what I get paid to do. We'll circle back to dilution in a minute, but first let's talk about valuations. Investors are in business to earn returns. The price to earnings ratio you hear about on Wall Street relates to the fact that the more a company earns, the more investors are willing to pay to own a piece of that future value. Early stage startups don't yet have earnings to use as a basis for share price. I should mention that the term EBITDA stands for earnings before interest, taxes, depreciation, and amortization. Besides making accountants sound important, EBITDA is a standardized measurement of the value that companies generate. So it's used to make apples to apples comparisons between different company financials. Drop a note in the Q&A or hit me up later for office hours if you want a deeper dive on EBITDA. So anyway, a common rule of thumb for startups is that each new round of investment should buy a 20% equity stake in the new company, in the post-money company. So just multiply the amount of investment by 5 to get the post-money valuation. When an investor deposits $1 million into the bank account of a company that was worth $4 million before the investment, the pre-money valuation, the company is now worth $5 million post-money because it has an extra $1 million cash. Way back in the mid-90s, an angel investor named David Burkus developed the Burkus method, which assesses a startup's value based off the 5 criteria you see listed here. It's quick and easy, but it's very subjective and it misses potential important factors like market size. And since it's over 20 years old, you should double these figures to reflect today's prices. There's about a dozen other valuation methods for early stage startups that we can circle back to later if there's time. At the end of the day, they all attempt to do the same thing. They assign a price to the company today that considers the potential future return on capital and risk and time. So now that you know how startups are valued, let's take another look at that dilution chart. So on the left-hand side here, we have 6 hypothetical investment rounds going down the screen, leading up to a $1 billion IPO. The colored bars on the right, again, illustrate how founders get diluted, and the black line that creeps up to the right shows how much those same founders' shares are worth on paper after each new round. So the second blue bar on the left-hand chart shows founders getting diluted by 20% after they raise that first $1 million of seed capital on a $5 million post-money valuation. Suddenly, those founders are worth $4 million on paper because they own 80% of a $5 million company. Then let's say the company raises a $5 million angel round at a $25 million post-money valuation. The angels get that orange 20% slice at the top of the third column, and it causes everyone else to give up 20% of their respective share. The founders give up 20% of their 80%, reducing the ownership stake to the bottom, 64% in blue. But that's 64% of a $25 million company. So the founders are now worth $16 million on paper. The light red seed investors get diluted at the same rate. So they go from 20% ownership down to 16% post-money. But on paper, they've also earned a 4x step-up valuation compared to their original $1 million investment. So they're happy. That cycle continues all the way through to exit. And everyone's pretty happy along the way, as long as their increasingly smaller slice is of a bigger total pie. So visualizing that same scenario with an actual pie here, the founders went from owning 80% on the left side of a $5 million pie in the seed round to eventually owning a little less than 1/4 of that $1 billion pie on the right-hand side at exit.
Mark, if I could just interrupt briefly and we could go back 2 slides. I think we're doing pretty good on the time. So I just want to take a second and maybe also like unpack what is happening in between each of these rounds and connecting that dot. So at each of these rounds, when as the company raises additional capital, the point is not to raise that capital and hoard it. The point is to raise that capital so you can deploy it in accordance with what your business plan is to get you to increase, to grow the value of that company, that 2 to 3x before the next round. And Mark said as much, but I just want to go back and say that is what is happening here as we see these step ups in value. And again, when you're doing that raise, you've got that plan. Okay, I need $4 million, not because I want to have it in the bank account and feel tough. I need it because I'm going to go out and hire this engineer. I'm going to go out and get this sales team. I'm going to do this and this and this and this and this. Sorry for interrupting. I just, yeah.
No, you're spot on. It's totally right. And investors want founders to spend that money achieving those milestones. They want you to create that value that they're hoping the company is going to generate with their investment. So that's your job as a founder, is to deploy that capital to generate that value. Okay, so there are more sneaky causes of founder dilution than just taking in cash in exchange for a slice of equity. So Jason started our presentation by showing this example of a founder who thinks they're giving up 20% equity in exchange for $1 million of seed capital. On the surface, the math seems pretty simple, but the fully diluted pro forma cap table looks very different once you consider what happens after all the options and warrants are exercised, the notes and safes are converted, a new option pool is created, etc. So in this very extreme example, that same founder goes from thinking they'll get to keep 80% equity after closing the seed round to actually ending up with only 43% on a fully diluted basis. So Jason, we can step through that math maybe at the end if folks are interested. For now, let's just have everyone remember that good legal counsel and an experienced startup CFO are your best defense to prevent founders from getting blindsided by this type of dilution.
I think that's right. And actually, Mark, if I think we're still doing pretty well on time. And what I'd like to do maybe is you and I can walk through and just sort of articulate, because I think we've got maybe 50% of the room in being sort of first-time entrepreneurs or so. Why is it you have common? What is it that you have options? Why you have warrants? So the common stock, again, usually go to the founders, maybe early employees, maybe folks who have exercised stock options. Stock options are going to go to advisors, consultants, other employees who are getting sweat equity, right? Warrants are very much like options, but they're not going to be part of your option pool. They're a right to acquire stock at a certain price. They can either be given, to, let's say, financial institutions, landlords, other service providers, or they can kind of sit on top of an investment as sort of some extra juice or some extra economic upside for investors who put money in, whether that's on a convertible note or some sort of other instrument like preferred stock. Notes and safes. Mark, do you want to explain what those are? I don't want to hog all the time here.
Sure. Well, like warrants, notes and safes are kind of an IOU. The investor gives money to the company, and the company says, I will give you stock in the future based off of certain parameters and percentages. And so you can't forget about that. You've promised to give a percentage of the company to those investors later, and that comes out of the founder's slice, the common stock, when you raise new capital in a price round. And convertible notes are required by law to carry an interest accrual rate that's, let's say, 4% a year. So if you borrow $100,000 from an investor on a convertible note, that note is going to accrue $4,000 worth of interest each year until it converts to stock, and that's going to buy more stock in the end when it converts. You want to go into the difference between notes and safes?
Yeah. So, I mean, I want to just, I want to piggyback off of what you said, which is many times if you're going to do a price round, right? So you're going to be doing a series seed raise, or you're going to be doing your first series A and you haven't converted over the notes, you haven't converted over the safes. By that point, sort of the safes and notes, they're already there, right? And hopefully you were smart. Hopefully you hired someone like Mark to help you. It doesn't have to be Mark, but hopefully you hired someone as good as Mark to help you out, to model it when you're raising those safes and those convertible notes. But if you didn't, kind of what's done is done. There might be some levers we can pull, but not likely. But being able to model out how those safes and notes interact, because depending upon what's gotten negotiated, it's not super intuitive. You need someone like Mark to help you do that, to model it so that when you're then figuring out how much of the company you're going to sell, you know how much you're going to have at the end of the day. So that's kind of that component. The sort of subset is when you are doing that price round, one of the things that is frequently negotiated is the option pool, and specifically the available option pool on the back end. And the reason for that is that if the option pool has to get increased after the round closes, then the dilution that occurs from that option pool increase falls to everybody who's in the company. That's even the new money that's in there. So the new investors, when they're negotiating that term sheet with you, want to make sure that there is enough room in the option pool for all of those hires that you have in that plan that you've hopefully put together and shown them. So that's why many times we sort of talk about sort of a rule of thumb of having 10% available after the close. But again, that's sort of a general rule because that's sort of typical what you would see. In your case, put your plan together, make sure that you've got enough room. And then, you know, if you don't need to have 10%, if you only need to have the 6.92%, that's what you can go out and sell to the investor. And a CFO, someone who can help you do some financial modeling, can not only help you with the pro forma cap table, but can help you with putting together some of that financial plan and data. Mark?
That's right. Yeah, don't forget, investors are greedy and risk averse. Their job is to make money and they want to mitigate risk. So the option pool is one way that they mitigate the risk of execution because it ensures that you have enough like powder in the keg to pay your staff the equity incentive to keep them committed to the mission all the way through to exit, and so that everyone eventually gets paid at liquidity. And so the fully diluted pro forma cap table calculates, well, what if every single option that you have available was issued and you know, diluted everyone else down to its core? That's the worst case scenario. It's possible that you have a bunch of remaining options that haven't been issued, that haven't been exercised, and that just means that everyone else who's a shareholder gets a little bit of a bigger slice of that pie. So Jason, let's pause on the numbers for a bit so you can talk more about preferred stock.
All right. Hopefully everyone's still with us. We haven't put anyone to sleep. Obviously it's something, this topic animates me and animates Mark. And hopefully it animates the founders. So here is one big reason why you don't want to start going out and trying to negotiate a term sheet until you've run pro forma cap table, until you've run the pro forma cap tables, until you know how much of the company you're selling. It's because of control. Now, control is sort of one aspect to something that's very important and what is being sold. The other is economics, and we're going to do a deep dive on it because economics is really kind of the name of the game, right? At the end of the day, even though Mark earlier said that you know, it increases the paper value of your company, you know, until there's a liquidity event, until you can change those shares into cash, you can't eat the paper. And that's what these control rights are about. It's a way to mitigate the risk of the investors. And they've got a couple of different ways that they can do it, but let's talk about why the number of shares that you're selling and modeling that pro forma cap table is critical. Because the preferred, we talked about different bells and whistles that they have. One of the rights that the preferred holders usually get is to elect at least one director or maybe multiple directors. And that right will remain in place until, you know, for so long as X number or whatever the negotiated number of shares are outstanding. So you need to know what the pro forma cap table looks like so you can figure out what's the right percentage to put in place. Okay, you know, you wouldn't necessarily, if you're company side, you don't necessarily want to say for so long as any of the shares are outstanding, because, you know, if they only have one or two shares, they're not necessarily economically aligned with the rest of the common holders, the rest of the company. So you got to map that out. The other real key, or one of the other real key components, are the protective provisions. So those are basically blocking rights that the preferred have over certain, you know, certain things that the company can do, whether business decisions or things that affect the cap table, the rights, the economic rights of the other shareholders. So those include things like liquidating the company, selling the company, issuing cryptocurrency. That was sort of all the rage in 2016, 2017. Changing the charter or bylaws. So being able to effect amendment or do a new financing. So you need to know, you need to run those pro forma cap tables, not only on a high level, but before you close or before you go out and solicit, before you start to soft circle, if you will, that's probably a better word, soft circle those investors. You need to know who's going to own what. So you know whose vote you will need to get in order to effect certain changes, whether that's a new financing or selling the company or incurring more debt, more trade debt, something along those lines. And then finally, another thing is that one of the features of the preferred is that it can convert to common. So you need to know, and one of the other features is it usually votes alongside the common for a lot of, corporate and decisions and other things along those lines. So, you need to know, okay, is the majority of the outstanding stock going to be preferred at this point, in which case the common effectively kind of doesn't get a vote? Or what does the breakdown look like, so that you can start running through with your lawyer and with your CFO, kind of what events are going to happen in the life of the company, especially between now and the next round, for which you will need to go out and get consent from these new stockholders. Let's talk about economics, Mark.
Yeah, thanks. So preferred stock also gets special treatment when the company liquidates, either through a successful exit or an unfortunate wind down. So a few of those elements here. Liquidation preference works to protect investors' downside by giving them a guaranteed minimum amount when the company liquidates. Usually it's equal to 1 times the original investment. So if your company fails, preferred shareholders will get as much of their original investment back out as possible before any other shareholder gets a cut. And even if the company does well, that liquidation preference still makes those preferred shareholders get a guaranteed return before other folks get paid out. Then there's seniority. Seniority, typically new money in has seniority over older money, meaning that Series C investors get paid out before Series B investors, who get paid out before Series A investors. Basically, everyone else gets paid out before common stock. The seniority doesn't have to follow that order, but that's typically what we see. And another one, participating preferred. Jason talked about it for a second on the last slide. Shareholders get to have their cake and eat it too, economically speaking. Preferred shareholders that have participation rights, because first they're paid the senior liquidation preferences, then they also convert to common stock and essentially get to double dip by splitting what's left on a pro rata basis with common stock. So drop a note in the Q&A if you want to see an example of this. We can run through some numbers in a spreadsheet. But I think I have a slide in the appendix that gives a good once over. The last one, participation cap. It limits preferred shareholders' participation in common as a multiple of their original investment. So it puts a cap on the double dipping benefit that I just described, so that preferred shareholders don't get to have the largest slice of the pie at every exit value. There's a limitation to how much economic benefit they get with those preferred rights.
And if I could just add, remind the audience that, again, this is sort of a hypothetical composite. Many of these terms are subject to negotiation. And if you want to talk about them more, we'll talk about them in the Q&A. Just use the Q&A function.
Yeah, I have a good slide that shows a few different scenarios with different economic benefits at exit, so we can see what those would net out to the founder.
Yeah, I've seen you've got good stuff, Mark.
Hopefully we'll get to it all. So this here is an example of what's called an exit waterfall that you get by running scenario models in your cap table in a fancy spreadsheet, or basically any of those cloud-based cap table management software tools available. You still need to know how to pull all the knobs and levers, but this illustrates for you the effect that all those economic benefits have on preferred shares at exit, as well as a few other factors. So because of the seniority, liquidation preferences, and participation rights underlying this particular example, The founders don't start sharing in the capital liquidity until above a $12 million exit value. If the company doesn't sell for more than 12 million, the founders get zero. All the money goes to the investors. So a participation cap in this scenario limits that green colored Series A preferred shareholders. It limits them to an $8 million payout at a $30 million exit. And that same $8 million cap applies for those investors even at a $46 million payout. So those investors are going to make the same $8 million payout, regardless of if the company exits for 30 million or 46 million. But the upside gets captured by the other investors that don't have those economic benefits on the preferred stock. So common stock, on the other hand, usually gets the biggest piece of the pie at big exit valuations you see on the right-hand side of the chart, but the smallest slice at low exits. By the way, this is one reason you hear about founders who turn down offers to sell early. It may be because they're just not going to get a big enough payday to make it worth their while to exit early, and they want to hold on to drive larger value so they can get that larger upside later down the road. To avoid surprises late in the game, we strongly recommend that founders look to their CFOs and attorneys for help modeling out these different exit waterfall scenarios before you agree to key terms on preferred shares. Like Jason said, before you soft circle those rounds, figure out where you have negotiating leverage and figure out how that's going to affect you in terms of control, voting rights, economic benefits, and your ability to raise capital in the future as well. Because if you have bad terms in an early round in the company, future investors might not want to get stuck in the mess there and have to clean it up, and they're just going to pass on you. So you got to keep things clean so that your business is attractive for new equity holders to want to come participate later. Jason, maybe you can tell us about a recent exit that you worked on and how things shook out economically.
Well, I mean, I think this model does a great job. What I want to do actually is just pick up on what you just mentioned a second ago, if that's okay, about keeping things clean, because I think it goes to one sort of fundamental premise or rule that I have or want to convey to entrepreneurs, which is that nobody wants to invest in a lawsuit because the outcome is uncertain and it's expensive. And with regard to that, going back to that soft circling and why it's important, you really need to think of a corporation, not necessarily as a democracy, but sort of as a bit of a republic, if you will. And you need to understand who are the folks who are going to need to, who will be your friends and allies when things get tough and you get in the trenches. Because kind of a little bit more closely to what Mark's question was, many times when things are not going so well, you may need to go out and do either a recap, and we've done a bunch of those, or you may need investors to give or waive certain rights in order to get a next round of financing or to get a deal done, right? So I've done deals where, some of the preferred have given up some of their preference in order to make sure that the common is able to get some little bit of a payout so that at the end of the day, they can get the deal through. But if you've got folks on your cap table who are only looking out for themselves and their own interests, and that's okay. I mean, it can be appropriate to have those folks in there, and investors do have duties to their investors to maximize the return on capital. But at the end of the day, you need to know who you can rely on when the stuff hits the fan.
Fair enough. So why don't you take us home, and then we can jump through some deeper dive examples in the appendix.
Yeah, I think this is great. So if I can leave you with some big pieces of information or some big takeaways, raising capital, whether it's a safe or convertible note, or you're doing a price round, is selling a piece of your company. You may not know it when you're doing a safe or convertible note because those, there's not going to be shares that are going to necessarily get pinned up on your cap table. Instead, you'll have like a little note saying you've got a safe with a $8 million cap and a 20% conversion rate. So it doesn't look like you're sort of selling a chunk of your company, but you are. So the best thing that you can do is model it out ahead of time. You can't, as a corollary to that, you can't make an informed decision as to the size of the piece or of the company that you're going to sell or the price that you're going to sell it for unless you model it out. as Mark pointed out, there are a lot of great tools, but you need to know what you're doing with those tools. Otherwise, you get sort of what they used to say in data, garbage in, garbage out. And then the model that you build is worthless. It's just it's actually worse than worthless, because you think you know what you're going to get, but you don't end up with that. So there are a lot of support tools out there, experienced counsel, outside CFOs who know what they're doing, building these pro forma cap tables and waterfalls. All those things are absolutely critical. Mark, did you have any other decisions, or excuse me, do you have any other information you want to convey before we break?
We'll run through some of that stuff in the appendix. Let's get this up here on the video. Just
this is my favorite slide.
In for a minute.
Yeah, this is my favorite slide. Again, just sort of warning folks that, again, this is for informational purposes only. I'm just kidding. It's not my favorite slide, but we did want to put it up because, again, this is for informational purposes only. Don't take this as legal advice. Don't take it as accounting advice from supporting strategies. And you certainly don't want to take accounting advice from me. With that, I think maybe we can move on to some of our bonus material, which is actually really where some of the meat is, if you will. I think.
Yeah. There we go. Let's look at this. Is this coming through? Yeah. Liquidation preferences. There we are. So here's a few examples of how different liquidation preferences can affect what's left to be paid out to founders upon liquidation. So for the sake of simplicity, in this example, dividends have been excluded, and we assume only one series of preferred shares, but it's definitely very common for preferred shares to be earning dividends over time that accrue, kind of like accrued interest on a convertible note. And those dividends get paid out when the company liquidates, before whatever's left over gets split between the common shareholders. So forgetting about dividends and assuming that there's just only one set of preferred shareholders and one set of common shareholders that have fairly standardized terms, what we see here in the first column is that preferred stock has no participation rights. That's kind of right below that first gray bar. So it just gets paid out. It's 50% of the exit price, because the preferred shareholders have 50% of the total shares in the company. And it leaves the other 50% for common shareholders. So if a company sells for $50, each of the respective groups get $25. In the third column, preferred stock gets a 2x liquidation preference, which means it earns 2 times return on its original $20 invested before anything else happens. It's a pretty good deal for the preferred shareholders. They invest $20 at exit. They get the first $40 of the profits of the liquidity value. And then what's left over, that additional $10, gets split 50-50 between the preferred shareholders and the common shareholders. So the common shareholders only get $5 out of that 50. It's kind of a raw deal. So in the last column, the preferred shareholders still have that 2x liquidation preference, but their participation is capped at $40. So once they get their liquidation preference, the rest of the $10 goes directly to the common shareholders. So that's an example of how you can negotiate on those special terms on preferred shares. So investors get to mitigate their risk and be accountable to their investors about the performance of the investment, but they don't get to, the whole pie to themselves. There needs to be some value left there for the shareholder, the common shareholders, and the stock option holders that are doing all the work in the company.
And if I can just provide maybe a little bit of context, I think you've implied it. But again, these are negotiated terms, right? So, it would be great if the sort of market for Series A companies in your niche were super liquid. You could go out and you could get 5 different term sheets and sort of shop them against each other. Okay. And that happens from time to time, in which case you've got probably a bunch more market power and you're in a much better position to get that non-participating preferred. If for whatever reasons, either because you're not necessarily in a hot space, or you're running out of runway, and so an investor is able to be more opportunistic, or there are some other real risk factors involved, right? There could be regulatory risk factors like, whatever it is that you're working on could get shut down by FINRA or the SEC or some, or the FDA. That sort of affects the pricing. So maybe that shows up in your valuation, or sometimes that sort of shows up on the back end here on some of these rights and preferences.
I agree. You want to jump to our Q&A log, see what kind of questions are coming in?
I think the only other thing that I'd love to touch on, if you feel like we can do it, is just talk about conversion of convertible notes and safes.
Good call.
Because I feel like probably based on the survey results, which I'll publish. Sorry, I just got so into today's conversation that I'm going to share the results. I think that'll be super helpful for folks. All right, yeah, we've got about 40% of the folks are first-time entrepreneurs. We've got 30% serial entrepreneurs. We got about 5% angels. Got some folks at growth stage companies. Some who are in the miscellaneous. In terms of geographical spread, we got 30% from Northern California, dwarfed by the rest of the US with close to 40%. We got some from down in Silicon Beach and some folks in Europe. And then again, people will be viewing things because I will send out the video in a week or so after this. So if you haven't got it, please feel free to contact me. Let's talk about safes and conversions of convertible notes.
Okay, so this is a very simple example we can walk through. The biggest difference from a financial standpoint between safes and convertible notes are that safes do not accrue interest, but effectively in all other ways, they perform like a convertible note. The company is effectively lending money, or sorry, the investor is effectively lending money to the company, and then later that debt turns into equity. Okay,
we just sort of say it's like a prepayment on a forward contract, but I agree with you. Like mechanically, it's the same. It's the exact same thing. It just doesn't have the debt feature and it doesn't have the interest rate. Yeah,
it's really a clever workaround because the convertible notes by law, according to the government, have to accrue interest in order to be, treated the way that they intend to be treated from a tax perspective and a legal perspective. And so safes were a really clever way around that, so that there didn't have to be interest accrual, and also so that you don't, like, another big problem that founders encounter with convertible notes is that they have a conversion deadline that happens. It's like a ticking time bomb. And you might not be ready to raise your next round and price the company for another few months or 6 months, but you have that in the contract with a convertible note, and that's going to convert to equity one way or the other. So oftentimes founders have to spend more time and effort and money with their attorneys to go get those notes amended to extend the deadline.
That's right. Yeah, absolutely.
Corral a bunch of cats to agree to do that with you. All those investors that were excited at the ability to convert at a lower valuation.
And they got leverage. So, I mean, at that point, when it's up against the deadline, they got leverage potentially. So hopefully you've chosen, those investors wisely, and you've got friendly investors, but, theoretically they could force you into bankruptcy if you don't, depending on the terms of the note. So Mark's right about that.
So get good legal counsel up front and figure out kind of the path you're headed down and choose the right instruments for that path and for your objectives. So in this spreadsheet here, we've got just a really simple example that shows $300,000 of convertible notes that accrue interest at 4% annually. And this assumes 2 years worth of interest accrual. They each have a 20% discount, which means that they get to buy shares at 20% less than what the next round of investors buy shares at in a priced round. And they have these valuation caps, which are common features of these tools, which basically protect the investor, that says that the maximum the investor will have to pay per share is capped at that level, regardless of if your company's worth more than that in the future when you actually convert those to equity.
And the net effect of that is that that comes out of the backside of the founders and the, you know, the current folks who are on the cap table that, you know, so that sometimes if it's too onerous, we can negotiate that and change that, but it's real. It has a real effect.
Yeah, that can be a sneaky dilution lever that erodes equity value of the founders and the you know, the option holders. Okay, so the math here is pretty simple. The interest rate usually is on a very standardized annual rate, simple interest. So multiply the $300,000 times the number of months times interest rate. So here we have it for in this particular example. And if people want to post in the Q&A specific numbers, we can run those numbers through the scenario and see what the answers are. But with these given inputs, what happens here is that if this company raises money at an $8 million pre-money valuation and a $10 million post-money valuation, these valuation caps are going to kick in. And the convertible note holders are going to have a discounted price per share of $3.20 per share. They're going to get that many shares because they're getting more shares than the safe holders, even at the same price, because that accrued interest buys them more shares at conversion. So convertible note holders win in this scenario. And here, like the converted notes get 4.61% of the company and the safes get a little less, 4.54% of the company. And then post money, like after the new investment comes in, everyone gets diluted, like we saw in those other cap tables. So here the note holders drop down to 3.69% because they have to give up a percentage, 20%, to go to the new investors who are putting in $2 million of extra money. So the return on that investment on paper so far is the notes holders get 20% increase, step-up basis, like increase in value from what they originally invested, and the safe holders get 1.2%. So I'd be very interested to run this scenario for other numbers that people are dealing with in their own business. Do we have any answers that have come through the Q&A?
I don't know, but I will just sort of comment, right, that the formula you built will probably work or get you close to whatever someone has. You know, as you know, Mark, you got to take a look at the note and find out how they define either company, what they say, it's either fully diluted basis or the company's basis or whatever in there to see kind of what gets included in that denominator and what doesn't. But I think that would at least get people close to probably what it is that they should be thinking about.
That's
Company
right.
capitalization is the word I was looking for, company capitalization, how they define it.
Let's do something here real quick. Just let's say the company they offered these instruments at a $4 million valuation cap. Then you can see how much bigger a percentage those instrument holders get after the new money comes in. And if this, let's say the pre-money valuation was just an extreme case, the business is really kicking butt. You blew past anyone's expectations and the business is worth substantially more when it raised new investment money. These people are still going to get to buy their shares at a $2 per share capped price, whereas the new investors are going to buy those shares at a substantially higher price. And so those people are going to basically get double or more the number of shares that they would have at a lower valuation. So these valuation caps matter. You need to really think about what you're going to achieve by the time you go raise a price round and realistically what the company should be worth at that point in time, and make sure the valuation cap is aligned with those targets.
But Mark, could you just say that again? Because I think it bears repeating.
Sure. It's about forecasting. You're raising money based off of a business model and a plan of what you're going to accomplish. What are you going to spend that money on? What will you achieve by the time you need to raise the next round of capital or exit the business, whichever comes first. So
and that's what you set the valuation cap at, right?
That's right. So if we think that the business can achieve a $10 million valuation before we come to the needing to raise another round of capital, you shouldn't have a valuation cap on your convertible instruments that's at 5 million, because you're basically promising those investors that they're going to double their money when you convert. And that's way too sweet of a deal that you're offering in exchange for early capital. You should, like, maybe if you want to give them some downside protection, you can set the valuation cap at 8 million or 9 million against your $10 million target. And then they have a built-in sweetener for giving you that money early, in addition to their 20% discount.
So when I'm company side, and I work mostly company side, I agree with you 150% on that. You know, the sort of purpose of these caps is to act as a sweetener in case you didn't set the discount correctly. That is, in case the company is, you know, able to use that money and stretch those dollars a lot further. Lots of times, especially first-time entrepreneurs, will take the position, well, a cap is a form of evaluation, and I want to set the cap at what I think the company is at today. And if that's the case, then to a certain extent, the discount is absolutely useless, and all you're doing is taking, you know, you're diluting yourself as you're going to use that capital to grow. And as Mark said, sort of maybe a good middle position is, you know, if you think you're going to hit 10, but you want to give the investor some extra juice, maybe you set it at 8.
Mm-hmm. We have a few other things in the appendix here that maybe would be good to talk about. We did the convertible notes and safes. You want to talk about down rounds?
Why don't we take a couple, since we're like kind of rolling up right on the 1 o'clock, we at least in my mind hit the things that I really want to make sure that we would hit. If you feel that way, I think maybe it makes sense. We can kind of go back and forth. You take a question that's specific kind of to what it is you do. I take a legal focused question. We can trade back and forth. And then if you want to go back to down rounds, we'll go back there. How's that sound?
100%. Yeah,
okay.
Let's do it. So why don't you start? I haven't taken a look at the Q&A yet.
All right. Yeah. All right. So I did see a question in there about my thoughts on post money safes. I'll try and give you my sort of 30-second overview. Before September, October of 2018, there was Y Combinator put together the simple agreement for future equity. So between 2013 and October of 2018, simple agreement for future equity safe. It was sort of on a pre-money basis. They redid that in October. So it's on a post-money basis. They sort of did it again, I think, in the beginning of 2020. That interim one didn't float my boat. The new post-money safes, I think they're, whether you use a pre-money safe or post-money safe, doesn't matter, so long as you've run the pro forma cap table ahead of time and you're able to model out what your business, forecasts and business plan are. So the pre-money safes, there are some things that we always change regarding the amendment provision and some other things. So, I mean, I wouldn't just run out there and do that on your own. I think you need to get competent legal counsel to do that. But I no longer kind of have a hard position between a pre-money and a post-money, so long as we're not using that interim safe that came out in sort of October 2018 until I think maybe January of 2020 or so.
Okay, good. There was a comment that there's no expiration date on safes. That's generally true. But there are legal documents open for negotiation. I guess it's possible to put one on there. What else do we have here?
So I answered that. Let me go, but it looks like there's another question as to pre-money versus post-money safes. So let me There are some changes in them that relate to where the cap table and the increase, when you're looking at the fully diluted basis, whether or not you include or exclude the option pool and the increase in the option pool that might be associated with the price round. That was one thing. Another thing that changed within the pre and post money safes dealt with making sure there was some more language in there regarding tax treatment that is treated as equity as opposed to debt. There's also some changes, I think, with regard to qualified small business stock. The post money safe has a better amendment provision so that if you get into that situation where, gosh, you set that cap like just way too low, you're able to have a mechanic so you don't need to go out and have each safe holder approve an amendment. You can go out and just basically get the holders the majority of interest of that type of safe. So, arguably it is better, and arguably it is a bit more investor friendly. But again, I think kind of what drives that, I'd still put it as, in general, more company friendly than a convertible note, because you don't have this interest issue. You don't have the maturity date issue. So that's sort of a highlight between what's the pre and the post money safes.
Okay. Let me pull this up here, screen 2. I had a question about like the shares that are authorized but not necessarily issued at dilution. So let's look at this example again. Here, this is pre-money. This is a business that the common shareholders own 80%. The preferred shareholders that are already on the cap table own 50%. And we're talking about bringing a new investment in for this, like for right here, according to these terms, which is going to be issued 6,250,000 shares. So this is what would happen if those were the only things we have to think about. But then we say, well, there's some stock options that have already been issued to, our founding team and other people working in the business. So if we consider all those options as exercised, they're going to get this many shares exercised, which is going to take 5% away from those other shareholders. Same thing with warrants. If we've got warrant holders that haven't exercised those warrants yet, they're going to get to exercise their shares. The convertible notes and safes we already talked about. The remaining option pool that hasn't yet been issued, if we had a 10% option pool, like Jason, you described earlier, which is a fairly common benchmark, and you've already given out half of those options to your founding team, and you still had 5% of options available, the fully diluted pro forma cap table is going to say, well, let's assume that you issue the rest of those options to current or future employees as incentives to keep them on. And so we need to consider those. And that's how we start watering this down and taking equity percentage away from the original equity holders and distributing them amongst other people who will get equity before the company liquidates. And then, as you said, Jason, investors are going to want to see that we have an adequately sized options pool in total. So post money, this is a pretty rich options pool that would be 20%. That's probably unrealistic. Maybe we take this down to 2. Maybe the original options pool is enough still, because we've got 8% that hasn't yet been issued and another 4.5% that was issued. So that's 12.5% total. That's probably enough, but this founder is going down to 50% of the total post-money equity once you consider all that fully diluted activity. Okay. There's an interesting question here, Jason, from Dave about when one person has over 50% of the voting rights, what prevents that person from voting to give himself more stock, or from doing other things like that that are
Yeah. So let me find it. and I'll try and keep my answer as pithy as yours. When one person has over 50% of the shareholder voting rights, such as Facebook, what prevents that person from voting to give more stock to himself, herself, itself, themselves? Well, so so let me go back and just sort of explain the mechanics of how corporations are run. So you've got the owners who are the stockholders, and they have the right, as I mentioned before, to elect the directors, and the right to receive dividends and the right to receive distributions from the company, whether that's because the company is winding up or issuing some sort of other distribution. It's the board of directors that makes the decisions in terms of how to run the organization, when to issue stock. Although, as you've probably seen, one of the things that gets negotiated in a preferred stock agreement is that the preferred stockholders have not a right to decide to vote stock, but a blocking right against issuing additional stock. And then you've got the officers and directors who are the ones that actually carry out the policy and the decisions of the board on a day-to-day basis. Now, with that framework in mind, what prevents a major stockholder, or maybe who's got control of the board, from issuing himself, herself, itself, themselves more stock? They do have fiduciary duties, the duty of loyalty to the corporation and to all of its stockholders, which include the minority stockholders, from taking unfair advantage of the minority stockholders. So that's what keeps them in check. In terms of, when they're meeting and not meeting that, there's a lot of case law on it. It's a case by case basis, but, there are many times when, I've got a founder or a few founders who maybe have had a departing founder at some point. And maybe it's not even founders. Sometimes it even involves having VCs on the board, and, they want to issue more stock. And this is an issue that we have to walk through. Is this going to be defensible? So that's what keeps them from just unilaterally issuing more stock.
Okay. We had a question about convertible instruments. Once converted post-funding, do safes and convertible notes become preferred shares? And yes, they convert to preferred shares with control rights and economic incentives that are predefined in the convertible agreement itself. So you got to negotiate those things up front.
Yeah, I mean, that is absolutely generally true. And again, within there, as Mark said, it's what's in those agreements. So sometimes they are sort of a stealth series. And so they kind of are shadow series. So they have, adjustments to their liquidation preferences, adjustments to their dividend preferences. Sometimes, one of the ways we solve this maturity date issue is to have them convert over into common. I don't usually do that in my docs, but it is out there. But again, that's all gets negotiated in the docs.
Okay. We had a question about from Al about some specific terms on convertible debt, and I'm trying to run the scenario out, but so let me go live here. We'll just see if this helps. Al said it's a convertible note at 7.5% interest, discount of 30%, and a valuation cap of 4.2 million. I don't know how much that note is, but let's say it's $500,000. Oops, that's too many. And then we're raising, if you're raising at a $5 million valuation, and you're raising, let's say, $1 million, then the convertible note converts at a discounted price, 30% less than the normal price. But if we're raising it like, let's say, an $8 million valuation, then this valuation cap kicks in. We take the lesser of, whichever share price gives a lower price for the convertible debt, that's the price they pay to buy their preferred shares. So it's hard to tell if this is bad terms. A 30% discount is steep for the founder. 30% discount implies that the investors are taking a really big risk in giving the money early, and they need to have a meaningful upside to be funding the business to get to a milestone where it can attract more institutional funding from a traditional VC. So an early stage investor might want that 30% discount to make it worth their while to take the risk and invest the money with you early. That can justify it. It just all depends on how long it's going to take before you get to the next round and raise your next round of capital, and how likely you will be to succeed in that.
Thanks, Mark. So we got a question. Are there ever situations where investors have negotiated clawback rights, presumably for the money that they've invested, based on performance targets or other things? So I'm going to answer that question. Look, I'm sure it happens, but the way that these deals usually operate, it doesn't happen that way. I mean, first and foremost, at the outset of today's presentation, I talked about control and how there are many different control rights. One of the biggest controls that investors have, or levers that they have to mitigate risk, is to just not put all the money that they could put into the company, right? So that shows up in the mechanics of the rounds, right? It's not like you raise, it's going to take $100 million to grow this company. So the investors all put in $100 million in your A round, and then that's it, you're done. That gets shaken out and gets broken out into those different rounds. Additionally, with regard to clawbacks, that's not usually how it happens. I mean, usually what happens is, rather than doing that, the capital will be deployed in tranches. So, rather than saying we're going to put in 6 and then take back 3 if you don't do this, they say we'll put in 3 now, and if this occurs, we'll put in another 3. And that also is probably related to the fact that companies are not usually in the business of buying back their stock, especially early stage companies. It's more comfortable and more appropriate for them to be issuing new stock rather than buying it back. So that clawback mechanism just probably wouldn't work very well and wouldn't be very palatable to the other people on the cap table.
Yeah. There was a question from an anonymous attendee. Any special valuation cap table issues with SaaS companies? I don't think there's any differences that the SaaS, business vertical would imply on the cap table itself. Really, we're investing in the potential future value of the company. So SaaS companies, if it's depending on what customer audience is servicing, have a likely potential to reach billion-dollar exit values. So I think those cap tables tend to be bigger and require more rounds of funding, because with a SaaS company, with many startups, with a SaaS company in particular, you're going to be reinvesting as much of your capital and profits as possible into growth to acquire more users, because you want to build that larger user base that's going to be paying the ongoing licensing fees that are your future revenue streams. And that's what your company is valued on, is how much future value it can generate from the software and the team and product that you've built. Peter, you asked what amount of shares should you use to start the options pool? My answer, selfishly from like a founder's perspective, is start with smaller, and you can always negotiate to increase the options pool later. If you give away more options now, then you don't have that negotiating leverage as a point with your future investors. Jason, you probably have some experience on that.
Yeah. So a typical way that we set it up is, if we got 10 million shares authorized, we'll issue, we'll split up 7 million of those 10 million, 6 or 7 million of those 10 million among the founders. And maybe we'll hold back 1 million or 2 million for the option pool, and we'll keep sort of another 1 million just authorized but unissued, because folks have a way of sometimes wandering in to be early employees, or maybe a later entry founder. In terms of like the real perils and pitfalls, I agree with Mark by and large. Kind of makes sense to start on the more conservative and small side. That being said, when you look at a lot of these safes and convertible notes, when it's sort of setting out what the denominator is for either fully diluted basis or the company capitalization, usually they have, including in there as either the option pool or like effective immediately prior to the financing. So, you're not going to get necessarily the biggest hit there because the option pool's got to be what it's going to be when you do that price round. Where you can get a little sticky is, if you're going to be bringing in a bunch of people and you're going to say you've got this percentage of the company, which I always try to avoid, I always try to counsel the companies not to do that because, again, companies are measured in the number, the owners are measured in terms of the number of shares that they own, not a percentage. And if you give a percentage, you got to be clear as to, is that just issued and outstanding? Is that on a fully diluted basis? If it's on a fully diluted basis, how are you treating the safes and convertible notes when you don't know how many shares they're going to convert into, because you don't really know what the pre-money valuation is going to be at the time that you do the conversion. So long story short, I agree with Mark, but it's not the end of the world if your option pool is a little bit bigger. And the other thing too is we can always right size that option pool. We can always actually adjust it down prior to a financing. So maybe that's too much information, but that's what they pay me for.
Okay, so we've got a good question here from Sonia Davidson. What happens when a founder feels he or she no longer controls the company? Do they leave? That's a real risk that investors are terrified of, actually, because they're investing in you, the founder, and your tenacity to stick with it for 5, 10, sometimes 15 plus years to achieve a successful exit where everyone gets paid and it's worth their time and money along the way. So it's important it should be important for savvy investors that the founder has enough skin in the game, as they call it, at each successive funding round along the way, that they're committed to stick with it. So let's look at that for a second here. I love visual show and tells. This is that same rainbow colored bar chart, and we can play with these numbers right here. So let's say, I'll make this a little bigger and focus your attention here on the pies that you see on this side. This blue slice is what the founder is left with. And here in dollars, 215 million, and here on the chart, we get to see how much value the founder will get at exit. So if this business needed to raise this amount of money to be successful, but it wasn't able to achieve these valuation milestones along the way. Let's say it's only this, like it only doubles the valuation at every successive round into the future. Well, right here we have some down rounds, which we can maybe go into in a little bit. So that might be a little too aggressive. Let me take this down here too. In this scenario, the founder will only end up with $4 million of value, and in each successive round, the founder isn't really looking forward to potentially getting more value at exit. So after a certain amount of time, the founder might say, what am I doing this for? I could go get a job at Google or Apple and make some stock and maybe have a better lifestyle, and I'm happy with that. I'm done. So that's what happens, and investors need to be careful for that. And that's why in some cases, like Jason said, you're able to go back to investors that have onerous terms in their preferred shares and negotiate them back to something that's more equitable so that everyone wins in the end and nobody is taken advantage
of. So Mike Zhang asked a question, not being a lawyer, are there any red lights to watch out for in any of these cap tables? Again, like these cap tables are for illustration purposes, I wouldn't necessarily try and target any of these particular. It's just something you kind of could see if you were randomly pulling out a venture-backed company, out of a hat of, out of 1,000. Now, doesn't mean that's right for your business. I mean, I hope one of the things that you'll take away from today's conversation is, the goal here is to think strategically, think about where you're headed, the pathway to get there, and then sort of work backwards and put in place a plan. Certainly, at least between this and the next raise. Mark, do you have some thoughts?
No, sorry, I'm thinking about 409A valuations, that next question that came up.
All right, why don't you take that one?
Okay. So 409A valuations are, the question is, how do we find and vet a credible service provider to do a 409A, and what's a reasonable price to pay for a 409A? So a couple questions we can unpack there. First, most of those cloud-based cap table management software tools offer 409A valuations as part of their package. The cost for a 409A valuation increases with complexity of the business and all those considerations, because it's just more work to perform that valuation as there's more things to consider. An early stage company might pay, $1,000, $2,000 for a 409A valuation. That cost can be multiples higher at successive milestones down the road. The 409A valuation itself is a benchmark. It's basically like a CYA for the company and for the shareholders, because it establishes a value for the shares objectively that's used as a tax basis for like how you pay income tax on your gains on those shares. And so if the valuation is set objectively too low, then it can be challenged by the IRS later under audit, and people could be surprised with having to pay extra income taxes on gains they weren't anticipating and they didn't budget for. And
maybe
valuation is too high.
Yeah,
penalties
no bueno.
too, right? So it's the IRS makes it the responsibility of the startup to get those 409A valuations performed with a reputable source that is going to deliver reasonably objectively accurate results that'll stand up under audit. Did you have anything else to add there, Jason?
No, I think that's spot on.
Okay.
So here's a perennial question. Crowdfunding. I don't know what your take is on this, Mark. I'm going to share my thoughts because I get this question a lot, and kind of what you see in your client base. But crowdfunding at the very least is not the same and not necessarily lined up with doing venture capital funding. I mean, maybe it could potentially supplement or replace some seed funding, but by and large, most of the clients I work with are not engaged in the crowdfunding process. The reason for that is several-fold. Until I think November, or maybe even now, I don't know. They just changed. The maximum amount you could raise was $1 million. I think it's now 5 million. There are some real financial accounting hurdles and costs associated with doing it. Additionally, you end up with potentially you end up with a lot of unaccredited investors on your cap table. And so you might say, well, why does that matter? Well, that can jam you up in subsequent financings, or can jam you up in an exit scenario where, maybe you're going to get acquired by a private company and that company's not going to pay all cash for that deal. And so they got to issue some securities. And so all of a sudden there are all kinds of informational burdens that are then sort of put into and onto the company to, before it can complete the transaction. So there have been some efforts in the crowdfunding industry to try and basically make some synthetic securities that sort of piggyback. So you've only kind of got one accredited investor on your cap table. I haven't really been tracking that super closely. Two, when I talk to VCs, by and large, they're not real wild about it for the issues that I just provided. That being said, sometimes we do see it kind of in a consumer focused space where it's also sort of being leveraged to build some brand and build some brand awareness. But, you know, in those spaces, usually something like a Kickstarter or something where you're selling some product, it kind of gets you more juice without a lot of the complications. So just crowdfunding, I think, can actually make it more difficult to get venture capital funding down the road, to be quite honest with you. Mark, what do you see?
I agree. There's a lot of compliance hurdles. Crowdfunding is, it's interesting because you get publicity boost at the same time as you potentially raise capital from investors. I think that if your product or service aligns really well with the audience that you're trying to raise money from, like Kickstarter and Indiegogo are really great examples there. You're raising money from people who want to buy your product or service. So that's pretty natural. But if you're building a consumer-facing thing that doesn't make sense to raise on Kickstarter or Indiegogo, crowdfunding might still be really attractive to generate a lot of buzz and to help you with kind of your product launch into market at the same time as you raise capital. But it's a slippery slope, and the more you want to raise, the more cumbersome it becomes for the company, not only to qualify to launch the raise, but also to comply later with, you know, you have to act like a public company in a lot of cases, depending on what type of crowdfunding.
For just small checks.
That's right. And Patrick can tell you all the no fun work there is to do in supporting public company accounting and compliance work. Also, there's high audit costs. So even if you have a brand new company that doesn't have $1 in the bank account and didn't do anything, you still, to comply with crowdfunding rules, depending on how much you want to raise, need to have your financials reviewed or audited. It's kind of silly, but you have to pay an accounting firm, an accredited CPA firm, to audit your financials, and they look at your bank statements, which shows zero, and they look at all the other transactions, and they have to charge you probably tens of thousands of dollars in fees to justify their time to perform that audit, just so you could raise that money on crowdfunding. And it takes time also. Those audits generally take at least a month or two to perform from start to finish, and sometimes they schedule out 3 to 6 months in advance. So you can't just decide tomorrow that you want to raise money on crowdfunding. It needs to be something that's carefully planned. There's another question on bank debt that we can answer pretty quickly. The question is, have you seen instances where the company is able to and takes a bank loan? And if so, would it be expected by investors that the loan is senior to any of them, meaning that the loan gets paid back before the investors get paid back? And yeah, that's often the case, where banks will lend money and the banks get paid back first, and then the investors get paid back second. So it's very common. In fact, banks are some of the most risk-averse investors out there. So they're only going to lend money to a company when they have reason to believe that that company has the means to pay back the debt with almost guaranteed certainty. And they definitely are going to be first in line to get paid if something goes sideways.
So I think we're about to close out our time, Mark and Patrick. I mean, it's been wonderful chatting with you guys today. What I'd like to do before we do that is maybe if there's anything you want to share, either of you want to share with the audience, whether that's an insight you want them to take away, and then also if you want to answer a question for them. And then if you just want to reconvey sort of who you are, how to contact you, I'll do the same after you. I'll let you go first. Yeah.
Sure. I'll say investors are greedy and risk averse. They're not bad. That's the business they're in. And so you just need to know how to work with them and align interests and incentives so that everybody wins in the end. And just get a strong team on your side, both accounting, tech, sales, marketing, legal. Surround yourself with experts and you'll do great. And contact us. You can find us on our website, LinkedIn. Jason's going to send out the recording. You'll have all of our information there, and we'll be happy to help you.
Patrick?
Echo Mark's thoughts and comments there. About investors, just proceed with caution with it. The decisions that you make now will affect you much further out into the future, and look for the trusted advisors that can help you out with that.
Well, thank you, Mark, and thank you, Patrick. It was wonderful to have you here today. I want to also thank Idea to IPO for hosting us. I want to thank each of our audience members for attending today. Look for that video in the next week or so. If you've got any questions, feel free to reach out to me. I do keep office hours because I want to try and feed the ecosystem and help everyone become better entrepreneurs. Again, I'm Jason Putnam Gordon. I'm with Pulsinelli. I'm a venture capital and emerging growth attorney. Thank you very much. We'll let you guys get back to building those great companies. Take care. Bye-bye.
Thanks, Jason.